What's going on, my fellow wealth creators? Matty Ice here. Welcome to another training. Today, we are going to be debunking 5 really stupid myths about cash value whole life insurance and utilizing it for the infinite banking concept. And I wanted to do this video because I just saw another video titled Never Buy Cash Value Life Insurance. So obviously it piqued my interest and it was pretty terrible. Really awful advice. It's a gentleman teaching his, I guess, newer agents in Primerica, and he's listing out 5 reasons why cash value life insurance is horrible and they should do whatever it is that they're going to sell instead. But my problem with this stuff is that it's extremely misleading and borderline deceptive, where people are I'm not going to say intentionally, but sometimes it really seems that way, intentionally trying to mislead people just to make a sale. They're trying to make something else look and sound really bad, and make their case about why they shouldn't do it so that they'll purchase whatever it is that they're selling. And I've got a real problem with that, because at the end of the day, like, I don't really care if people do buy term and invest the difference. If you do infinite banking with whole life insurance, if you do real estate, cryptocurrency trading, if you want to buy an IUL, you guys know I'm not a fan of IUL. Whatever it is you want to do, I don't really care. You're an adult, do what you want with your money. Whatever is going to be best for you, though. That and in order to make the best financial decision for yourself, you have to have the facts, the right information, and know what your options are. So when this gentleman is bashing cash value whole life insurance, I don't have a problem with people that are not fans of whole life and like it doesn't make sense for them. But to purposely give and provide bad, wrong, just completely inaccurate information is not okay in my book. And so that's why I want to do this video, to debunk these really dumb things that this gentleman says about cash value whole life insurance, so that at the end of the day, you can make the best decision for yourself. So what I want to do is share my screen really quick. We're going to play through the part of the video where he's providing these 5 really stupid reasons not to do cash value whole life insurance, and we'll talk about each one. I'm also going to have additional like supplemental training on each individual topic that we're going to cover as well. So if you want to go in more depth, make sure you check that out. But I'm not going to play the whole video, just a certain segment. I'll link the whole video down below if you want to watch. If you want to watch the whole thing, it's pretty bad. But yeah, let's get into it. All right, here we go.
Always go through at one point. I'll go through the rule of 72, and the only reason why I'm doing this is because I want to make sure that the client understands that there's a major difference between 3% interest and 12% interest. As a matter of fact.
That's another thing. That this isn't part of like the 5 myths or whatnot, but I've heard this a few times with people that are fans of mutual funds, stock market, buy term and invest the difference. Again, I don't necessarily have a problem with that stuff, but he's now saying there's a big difference between 3%, which he's talking about earning in a cash value whole life insurance policy. You typically net 3 to 5%, whatever, and then he says 12%. Where on earth are you earning 12% every single year, uninterrupted, compound? Like, where's that number coming from? I've heard that a couple of times. Maybe it's true. Drop it down below, guys. If you're earning 12% on average every single year in some kind of market product, I'm assuming, like with companies like this, they're usually investing in some kind of stock market product. I would love to see that. And don't give me numbers about like the average rate of return of the market over however many X years. I'm not interested in that. I'm talking about real numbers where somebody is earning 12% every single year, because otherwise you are just throwing pie in the sky. You're sharing numbers to make something sound just far better than it actually is, and I'm not even sure how that's legal. So yeah, anyways.
There's a difference between getting $40,000 in 48 years and in 42 years getting $1.2 million. That's the difference between a 3% rate of return and a 12% rate of return. If they can understand that, then when you explain...
If you can get 12% every year, sign me up, man.
Plan A, or Bank A, we call it. When you explain this, it'll make a little bit more sense to them, okay? On average, you get 0 to 5% interest on your savings, 6 to 8% fee to withdraw your money. Number 3, 6 months to defer your money. So if you ever need your money, you got to let me know 6 months in advance for me to give you that money. I can withhold that money up to 6 months.
It's not true.
Number 4, they keep all your first year's deposit. So if you give me $1,000 that first year or $10,000 that first year, the Bank A right here, they're going to keep that money.
That's number 4.
100% of those first year's deposits. And lastly, if you die, so your family doesn't have to fight over the money, Bank A is going to keep all of the savings. In most cases, all of the savings they're going to keep. All right.
Okay, let's have some fun. You guys catch all the 5 reasons there why cash value life insurance is so terrible? All right. Should also, the video is titled "Never Buy Cash Value Life Insurance." Right in the description, he puts, "Never buy cash value life insurance policy. It's the worst financial product in the history of financial services." That's a pretty bold statement, and I can't stand when people say that stuff. Like I said, I'm not a fan of index universal life, but I would never tell somebody to never buy it, even though I would never buy it. Therefore, I definitely never recommend it. But I would never say to never do it, because I don't know what your situation is. I don't know what your goals are. I don't know what your risk appetite is. And if an IUL makes sense for you after you have all the facts and you actually understand how it works, which once you do, you typically tend to run the other way. But if you understand how it works and you want to do it, who am I to tell you not to never buy that policy? Do what you think is going to be best for you. But purposely misleading people, I'm not okay with that. So let's talk about these 5 myths that he's sharing here about cash value whole life insurance. All right. So number 1, he said a 0 to 5% rate of return. Okay. Not really sure what he's talking about with 0, unless he's maybe categorizing, he's throwing in like IUL as well, where you have the 0 floor. Maybe that's what he's talking about. But with cash value whole life insurance, there's a guaranteed minimum growth rate. It's typically between 2% and upwards of 3.25%, depending on the company that you go with. That's a guaranteed rate that the policy grows by. All right. And then, of course, you get dividends on top of that, which are not guaranteed, but most of the companies, at least the ones that we work with, these mutually owned participating whole life insurance companies, they've paid a dividend every single year since inception for over 100 years, sometimes over 100, like almost 150 years. So they're pretty consistent. So it typically ends up being like a 3 to 5% net internal rate of return after all fees. But also, you need to remember all of the other benefits too. Like when we're talking about internal rate or just rates of return in general, especially when it comes to cash value whole life insurance, I always consider the 3 to 5% as a bonus. Because the way that I use my policy, utilizing the infinite banking concept, I use my policy to build wealth with other opportunities. The 3 to 5% that I get every single year, uninterrupted compound growth, tax-free, to me, that's just more of a bonus. Are we going to get super rich on that? No, but also, plug some numbers, like play around with a compound interest calculator, guys. At 3 to 5%, if you fund your policy properly with enough money, I mean, that number, in 30, 40 years can be pretty significant because it's uninterrupted and it's tax-free, which when it's tax-free, like the tax advantages you get, I mean, realistically, you have to add like another 1 or 2 percentage points on top of the 3 to 5% to account for all of the money that you're saving in taxes as well. So for a savings alternative, which is what cash value life insurance, whole life insurance is, it's a very good savings alternative, bond alternative, things like that. It is fantastic as far as the internal rate of return. So he's bashing cash value whole life insurance because it only gets 0 to 5%. He's not talking about the fact that it's uninterrupted compound growth. It's 3 to 5%, uninterrupted tax-free compound growth. Not to mention all the other benefits that you get, the liquidity where you can borrow against it to pursue other opportunities. Which segues into myth number 2 is he said you have to pay 6 to 8% in fees to access your money. And this is I'm assuming he's talking about the interest rate on the policy loan that you take, which is true. Okay. But he's talking about it like it's a bad thing. I did a full trading on this, guys. Check it out in the description about why it actually makes sense to pay a little bit of interest to have access to your money while to use it for other opportunities, emergencies, etc., while it continues to grow to get uninterrupted compound growth tax-free. So I'll give you a real quick example. Again, go through that training though. A real quick example. I recently used my policy to purchase 2 pieces of heavy equipment that my partner and I are going to flip. So he's going to renovate them, resell it, and we're going to split the profit, rinse and repeat. But So on that deal, typically like the rate of return will be like 10 to 25%. I've seen it upwards of 40% annualized rate of return. Not on each deal, but like the annualized rate of return. But I mean, it could be pretty good. But so I make money over here on this opportunity, and then I pay back the policy loan. The profit I made on that opportunity covers the interest cost. Everything else is pure profit. Plus, my policy continued to grow at the 3 to 5% uninterrupted while I was taking advantage of that opportunity. On what planet does that not make sense, guys? Because I'm pretty sure that's what banks do as well. So, or very similar, where you make a deposit, they pay you 1%, but then they lend it out at 5%. So another example would be doing a private money deal. Like if you're in real estate, if I can borrow at 5.5%, which is my current policy loan rate, and I lend it out at 12%, is it not worth it to pay the 5.5% to make the 12? Because when I get paid back with the 12, that's going to cover the policy interest. Everything else is pure profit. Plus, I got the 3 to 5% while I was using my money. Where does that not make sense? Please drop some comments down below where that does not make sense. Number 3, he said, I think it was number 3. Might go a little bit out of order, but he said that they can withhold your money for 6 months. I have to give a 6-month notice if I want to use my money. That is absolutely not true. I think technically it's in the contract. It's in a whole life insurance contract for the company. They basically they're able to withhold it up to 6 months for whatever reason. I'm pretty sure that's usually because like if somebody is abusing the policy, if they're taking too many policy loans, they're putting the policy at risk of lapse. The company reserves the right to withhold the money, or like withhold the policy loan up to 6 months, or delay it 6 months. But anytime, like I've taken 3 policy loans so far, I've got my money in 2 or 3 days, deposited directly into my account. So he's talking about the absolute worst case scenario here, which is very unlikely unless you're abusing your policy. There's really no reason for them to do that unless you're abusing the policy in the loan feature, and it could they think maybe that you'll end up lapsing the policy. But it's your cash value, guys. They are contractually obligated to give you the policy loan, right? So yeah, he's explaining the worst case scenario there. Let's see, what were the other ones that he said? Hang on one second. Okay, yeah. So I think number 4 was they keep all of your money in the first year. Okay, again, he's only telling half of the story here. He's doing the same thing that Dave Ramsey does when Dave Ramsey bashes whole life insurance and why it's a terrible investment, which is not an investment. It's a savings alternative. It's a life insurance contract. But Dave Ramsey says that whole life insurance is a terrible place to put your money. They take all you get access to no money in the first year. It takes forever to break even. He's talking about traditional whole life, and that's what this gentleman is talking about too. Traditional whole life, where it's not set up for high cash value. People are only buying it for the death benefit. When you do 100% base policy, whole life policy, which is a traditional whole life policy, you're not custom designing it or structuring it for cash value. That is correct. The first 1 or 2 years, the base premium, you don't really see any cash value. Usually don't see any cash value that you have access to in the first couple of years. But guess what? You don't have to do that. You can custom design and structure your policy however you want. You can direct however much money you want towards base premium and paid up additions. It's basically paid up life insurance. Okay. And when you do that, you can have access to a lot of cash value in the first year, just like I did. When I set my policy up, I had access to roughly 85%. It's like I got to run the exact numbers, but like 85 to 90% of my money in the first year. And within the first 30 days, I had access to it to start taking policy loans, which I did. And so I purchased a vehicle to eliminate opportunity costs. I just consolidated all of my mother's credit card debt. I again took the loan to invest in the equipment as well. Like, so what are you talking about? You don't have access to they keep all your money in the first year. That's not true unless you're setting up 100% base policy. Again, it's only telling one side of the story to make whole life cash value whole life insurance sound bad, so that you'll buy whatever it is that he's selling over here. And he talks about it throughout the video. I do encourage you guys to go through the video. This is the kind of stuff you really want to watch out for, where people are purposely, or at least it seems like it's very purposely, leaving out a bunch of very important information that would otherwise influence your decision, so that they can make the sale. And he talks about making the sale like a bunch of times throughout the video. It's really just shady, in my opinion. But anyways, myth number 5 is when he said, in order, I don't even remember how he described it, but he said basically the evil life insurance company keeps all the money that you save. They keep all your cash value. This is ridiculous. All right. Again, I've got a video on this. I'll put in the description. It goes into a lot more detail, but here's the essence of it, guys. Here's the basics. The cash value is baked into the death benefit. Okay. When you're making premium payments and your cash value is growing, you're getting that growth rate, you're getting dividends, whatever. The death benefit is growing with the cash value. And the death benefit will always be higher than will always be a higher amount than the cash value up until like age 121 when the policy matures and endows. All right, but the death benefit grows with the cash value, so the cash value is baked into the death benefit. And what happened, and we want it to be that way because of the tax code around life insurance death benefits. With death benefit inside of a life insurance contract, it's passed on to our beneficiaries tax-free when we die. Okay, this is a good thing. My question is, do you want to give your loved ones more money or less money, and do you want them to pay taxes on it or not pay taxes on it? Because that's what the death benefit does. It gives them more money than the cash value is, so they're getting more money, but they're also going to get tax-free because it's a death benefit. If they got the cash value, which is the saving aspect, there would be taxes on it. But because it's baked into the death benefit and it's coming from a life insurance contract, it is tax-free. So we want it to be that way. You wouldn't expect, like the analogy I give in my training is if your home is worth, let's say $200,000 and you have $50,000 worth of equity. If you sell that home for $200,000, are you going to keep the $200,000 plus the $50,000 in equity that you have? Or would you only keep the $50,000? Right? You wouldn't get both. So why do you expect to get both the cash value and the death benefit? Like we wouldn't have life insurance companies if that were the case. But they're not stealing anything. The cash value is baked into the death benefit, guys. So when you hear this stuff, like just take it with a really big grain of salt. Okay. Just at the end of the day, make sure you're doing your research. Okay. Don't even take my word for it when I say these things. Do your research, guys. That's how I came to these conclusions, is because when I started going down this infinite banking rabbit hole and learning about IUL and cash value and whole life insurance and all these things, there was so much conflicting information out there. It's just one of the reasons I started this channel, to hopefully try and cut through the noise for you guys a little bit and share my journey. But just at the end of the day, don't take anybody's word for it. Do your own research. Listen to both sides of the argument. Just don't take anybody's word for it. Like I just when I hear videos like this, and I'm picturing the people, like the agents that he's teaching to share this terrible information with people. I'm just imagining the person that's listening to it, and they don't do their research and they make financial decisions that are potentially life-changing based on faulty, inaccurate information. It really frustrates me. So anyways, guys, I hope that was helpful. If you have any questions, drop some comments down below. Again, please make sure you check out the additional training in the description. It's really important if you are looking into or interested in infinite banking or cash value life insurance, whatever. The most important thing is to become educated. You don't have to become an expert, but understand these basic things so that when you hear stuff like this that this gentleman said, you know that, okay, there's something else going on here. He's not telling the whole story. All right, so don't fall into that trap. So either way, I hope you guys are crushing it, and I will talk to you in the next one. To your success. Matty Ice is out.